Hello, welcome back. This is our 100th episode, and today I'll be talking about the best semiconductor AI stocks to own in the stock market today. So in today's video, I'll be covering a few things. We'll be covering Nvidia as well as Salesforce earnings, the best AI companies to own, as well as some questions that you guys have left me in the comment section below. So let's talk about Nvidia's earnings first. Nvidia in the past month alone is up around 50% from the lows in April, and currently now the stock is trading at around 45 times earnings. It's up around 5% today after earnings itself. And for Nvidia, the company just reported blowout earnings. So the earnings were great all around. So they grew revenue by 69% year on year. They grew operating income by 29% year on year. And they had a H20 chips headwind as well. And despite that, they still grew around 29%. So overall, the earnings were great. But there's a metric that you should be paying attention to, which is their gross margins. Their gross margins over the past quarters has been slowly declining. And this typically happens when a company no longer has pricing power or when a company faces a lot of competition. So when you want to own your stocks, you want to own stocks that have high gross margins, and you want to also make sure that that company is able to maintain those margins, because them maintaining the margins means that they'll be able to fend off all the competition and all their competitors and still price their products at a very high price. So for Nvidia, this is one metric that you should be looking out for in the next few quarters. If the gross margins continue going down, then this could signal Nvidia's weakening mode. So for Nvidia, here are some of the tailwinds for the business. So your cloud demand isn't slowing, so they will definitely still need a lot of Nvidia chips to power all the data centers, and Nvidia will definitely benefit greatly from it. And Nvidia's technology is now essential with their CUDA library and then branching out into other ventures as well. So mainly for Nvidia, their chips are simply too high tech, too high demand, and that is why you're still seeing this company having explosive growth. But for Nvidia, I'm not adding into this one because of a few reasons. I wouldn't touch this Nvidia because I'm not too sure what Nvidia's moat is. A moat of a business is the ability to defend off its competitors, and as we saw earlier as well, their gross margins have been decreasing almost every single quarter since the boom in 2023. Besides that, you also have competitors from AMD, and then you have the TPUs as well, so all the different hyperscalers, them coming out with their own chips and specific designs for their own use cases. They could branch out those use cases, and that will hurt Nvidia's revenue because Nvidia derives a lot of their revenues from all these three hyperscalers, mainly Microsoft, Amazon, as well as Google. So while Nvidia chips are essential right now, the cost of AI will be significantly lower in the future, and typically the hardware companies, they will suffer the most when that happens, when your products become commoditized. Next portion, I'll be talking about Salesforce earnings. So Salesforce today is down around 6%. Currently, the stock now is trading at a 40 times earnings, and year to date is down around 20%. So for Salesforce, this is their earnings. Their earnings were decent. So revenue grew 8% year on year. Subscription grew 8%. Operating cash flow up 4%. Free cash flow up 4%. And overall, the business is just steady and they're returning to shareholders as well. But the streets didn't like the earnings. So for Salesforce, they even upped their guidance as well. So currently now, they're projecting an 8 to 9% revenue growth and a 9% subscription growth as well. And they're guiding up their EPS estimate this year as well, and projecting around 9% free cash flow growth. So Salesforce is a company that is maturing, the growth is slowing, they're doing acquisitions for growth. And normally when you see your companies doing acquisitions, doing defensive acquisitions like Adobe back a few years ago, this is typically when you want to consider selling your position, because this clearly shows that the moat is weakening or the growth is slowing, and the management has to go and acquire all these businesses to push up the numbers for Wall Street. So Salesforce moat could be weakened as well in the future with agents. Agents could replace the traditional CRM. So if you're bullish on AI, this could hurt Salesforce as well. They're currently pushing the Agentforce story, but the stock is still trading at a relatively high valuation, around a 40 times earnings. So for me personally, I would avoid this one. There are better software names out there. Intuit, for example. Intuit is a monopoly in your tech space. And you have other companies like ServiceNow, all these companies that are much high growing, although they're trading at a higher valuation as well. So I would place those ahead of Salesforce. For Salesforce, unless this company drops to 20 times earnings, I don't think I'll be entering into this one. Next portion over here, I'll be talking about the semiconductor industry as well as what are the best AI semiconductor stocks to own. So this is your semiconductor ladder over here. So I'll be going in depth into each of the portions in this ladder over here. So let's talk about the bottom of the chain first. So the bottom of your chain is your IP providers as well as your EDA tools. So your EDA tools, you have Synopsys as well as Cadence. So EDA is basically them creating a system, creating sort of like a platform where they model all the different possible errors that could take place when you're manufacturing your semiconductor. And in that industry itself, Synopsys and Cadence, they hold a duopoly in that space, as well as Siemens. And then in your IP segment, you have companies like ARM, Synopsys, Cadence as well. Those three companies are the dominant one. ARM provides some sort of IP to Apple. So when Apple grows, ARM will grow as well. As for Synopsys and Cadence, Synopsys holds the widest IP library out of these three companies as well. So this portion forms the bottom of the semiconductor chain. Let's move on to the next one. The next one is your wafer fab equipment section. So these companies over here, they make the tools to go and make the chips. So you have companies like ASML, you have KLAC, you have AMAT, you have Lam Research. All these companies, they make a certain equipment to go and make the chips. And the largest segment out of your wafer fab equipment section is your lithography, of course, which is by ASML. Next portion is your fabless chip companies. So what these companies do is they will design the chip. So Nvidia is in this segment. You have AVGO as well. Apple, Broadcom, AMD, Qualcomm. All these companies, they design the chips and then they pass it on to the chip makers to help them make the chips, and then they will go and sell it themselves. As for the chip makers, these companies are your foundries. So your big foundries, they are TSMC, Intel, as well as Samsung. SMIC produces less advanced chips, whereas Samsung and TSMC, they're competing to produce the most advanced and the most high quality chips. So as for the best AI companies to own in this semiconductor space, the two companies that I prefer the most is ASML as well as TSMC. So over here, there's a comment that says, I find TSM offers better value growth return potential than ASML despite their monopoly if you compare all the metrics of both. So I'll be diving into these two companies over here. So the first one is ASML. ASML, they sell these massive machines, and these machines, they cost up to $450 million. They're producing a Hyper NA1 in the future, which will cost a lot more. So for ASML, this is their guidance in 2030. In 2030, they're projecting a $44 to $60 billion worth of sales, and which is double of what they did last year in 2024. So in 2024, they had around $28 billion worth of sales, and they're projecting between 44 and 60 billion in 2030. So for ASML, they have two main business segments. They have your installed base management portion as well as your system sales. Your net system sales is them selling the machines, so your EUV machines. And for ASML, they hold 100% market share in your EUV space. So there's no other company that sells EUV machines. And in the DUV space, they have estimated that they hold around a 90% market share. So every single company, every single high-end foundry will have to go through ASML. They have to buy the EUV as well as the DUV machines from ASML. And for ASML, the installed base management portion is actually an incredible business as well. So your installed base management is projected to grow a 13% CAGR from 2024 all the way until 2030, which is quite remarkable. This portion over here is where they provide maintenance for all your different ASML machines in the fab. So this is almost a 100% retention rate business, and it's just recurring revenue for ASML because it normally takes around 4 years for someone to be trained to operate an ASML machine. And for all your foundries, I'm sure they have a lot more things to handle than to handle the ASML machine itself. And they'll likely just hire the ASML workers to be there and to make sure that the machines are working. So this business segment over here is quite incredible because you have the existing machines. The existing machines, they last for 30 years plus, so they're working on that already. And on top of that, you have new machines coming in as well every single year, expanding that installed base portion. So for ASML, this is an incredibly reliable and predictable growth path ahead for its installed base. And so that's why ASML is a high quality stock. Next one that I'll be talking about is TSMC. TSMC is a company that is in Taiwan. So for TSMC, they hold around a 90% market share in the high-end chip portion, and their scale is just incredible. They're not completely reliant on Nvidia. In fact, only 20% of their revenues come from Nvidia. So they have other companies coming to them and making chips as well. So you have companies like AMD, you have companies like Apple, all these other companies, they come to TSMC and then they get TSMC to make the chips for them. So it's the lowest valuation multi-business in the semiconductor space, around a 22 times earnings. And for its moat itself, I think it deserves a much higher multiple. Around a 30 times earnings would be justifiable. But the problem with TSMC is this. Taiwan will be the epicenter of any China-US conflict. So semiconductors are given moats because they are national security, but this could come back to hurt them as well when there's geopolitical tension. Buffett once owned the company as well, but he sold out almost immediately because he cited that Taiwan is a dangerous place for him to invest his money in. So this is Buffett's take on TSMC. This is why he sold the company.
This question comes from Rohit Bellany. Berkshire bought a substantial position in Taiwan Semiconductor and, contrary to its normal holding timeline, sold almost the entire position within a few short months. While you cited in a CNBC interview that geopolitical issues were the catalyst, these issues were seemingly no different when you acquired that stock. So what else, if anything, changed in those few months and prompted the firm to offload close to $5 billion worth of Taiwan Semiconductor shares?
Taiwan Semiconductor is one of the best managed companies and important companies in the world. And there is not, and I think you'll be able to say the same thing 5 or 10 or 20 years from now. I don't like its location, and I've reevaluated that. I mean, I don't think it should be any place but Taiwan, although they will be obviously opening up chip capacity in this country. And actually, one of our subsidiaries that we got in Allegheny is participating in their Arizona construction activities. But it's a question of, we would rather have the same kind of company, and there's nobody in the chip company, there's no in the chip industry that's in their league, at least in my view. And the man that was a 91-year-old or so that connected with it, that I think I played bridge with, and in Albuquerque, and marvelous people, marvelous company. But I'd rather find marvelous people. I won't find it in the chip industry, but marvelous people and marvelous competitive position and everything. I'd rather find it in the United States. I feel better about the capital that we've got deployed in Japan than in Taiwan.
Yep, so Buffett said that he sold his position because it was simply located in Taiwan. And for TSMC, I think there's a risk of your money going to zero, and that's why I'm not planning to invest into TSMC as well. Although the possibility is almost zero, but there is still a possibility of that happening as well. Another company that's interesting as well is Synopsys. So Synopsys is in your EDA segment, and they hold a duopoly with another cadence company. Synopsys fundamentals are quite good, but I don't really understand the business yet. I'll be looking up into this one, and I'll do a deep dive into this one if I find it interesting enough, or if I find that the business is high quality enough for me to do a deep dive in it. Last portion, I'll be talking about some questions that you guys have left me in the comment section. So the first one over here says, hello, I have a few stocks. I'm debating whether or not to purchase. I'm trying to choose between XOM and CVX. I'm looking at Disney and UPS. I was wondering if I could get your opinions on this. Thank you. So ExxonMobil as well as Chevron, these two companies are oil companies. For me, I think oil companies, they're very tied to your oil price itself. So when oil prices go up, then these companies will go up. When oil prices come down, these companies will go down. So if you want to invest in the oil industry, you need to make sure that you can time the bottom in terms of your oil prices very perfectly. And the other thing for you to take note of as well is in your oil industry, pick the ones that can dig up the oil the cheapest. So these companies include Oxy, Petrobras. These two companies, they have the highest operating margin. And for Oxy specifically, they have an IP to dig up the oil the cheapest. And that's why Warren Buffett has been heavily investing into that one. So ExxonMobil as well as Chevron over here, I don't think I'll be investing into any of these, simply because it's outside of my expertise, and I typically don't like oil companies unless they're really deep value. So those two companies are avoid for me. As for Disney as well as UPS, Disney is a company that is woke, so I don't think I'll be investing into that one. It cannot compete with Netflix in terms of your streaming area, and their cable network is slowly dying already. So the only thing that's going for them is their movies as well as their parks. Movies are cyclical because when economic conditions are good, your movies tend to do well, and they're also subject to innovation risk as well. So for example, Disney's Snow White film was a failure, and that could eat into their earnings as well. So for Disney, I don't think it's a company that I'm interested in. Next one is UPS. UPS is getting their lunch eaten by Amazon. Amazon is partnering up with all your different other delivery services. And UPS is in a space where it's highly reliant on Amazon to pass on their parcels to them. And so for me, I don't think I'll be investing into UPS. I think a better company to invest in is to simply invest in Amazon directly. Next comment, why do you prefer Baba over Tencent? They are not exactly the same business, but there is some overlap between the two. And Tencent seems to have better metrics overall as well. So yes, Tencent is the more stable business, and the valuation is also slightly higher. So Tencent is trading at around 22 times earnings, Baba is trading at around 15 times earnings. And for me, I think the main reason why I'm drawn towards Baba instead of Tencent is simply because Baba is a business that is recovering. Baba has the catalyst behind it. So Baba has the AI story going for them, and then they have the retail side of the business that is growing quite rapidly as well with the stimulus checks coming in from the government. As for Tencent, the ecosystem is incredible. They own WeChat, but the segment that I don't like about their business is their gaming portion. Gaming is subject to regulation in China. So China previously had a gaming crackdown on the youths, and that will be bearish on the stock. if all these regulations persist. So out of the two, Baba and Tencent, I think Baba is the higher value play now because of the lower valuation as well as the higher growth. So that is the main reason why I'm more interested in Baba as compared to Tencent. Tencent is a high quality business as well. And if the Chinese macro environment can continue growing at this pace without going through what they did over the past 2 or 3 years, then I think Tencent will be a quality business that will compound 10-12% over the next few years. Last one, congrats on the next 100th video. Been watching since you popped up. As a young investor, who has inspired or helped you the most in investing, and who will you recommend to follow in this investing space? Of course, we should always do our own due diligence, but when starting out, we have to build our foundation in some way. Thanks, and wishing you all the best for your channel and investment journey. Thank you so much for this comment. So, as for who I've been speaking to, there's another channel. You guys can go and check it out. It's called Ethereum Capital. This person is a friend of mine, and we will always exchange ideas about stocks. As for who I follow in the investment space, I think Warren Buffett is simply just the best mentor that you can have out there. His Berkshire annual meetings are great, and his books are great as well. So I think books are stores of knowledge, and for me, I think you can find a lot more knowledge in books as compared to your courses that are sold by all your different other Singaporean YouTubers over here. So books, and if you want some book recommendations as well, leave it in the comment section. I will send you some of the book links that I've been reading and looking at. I hope you guys have found this one useful, and invest safe.